All right. Hey, everyone. This is Noel Christopher with Renters Warehouse, and this is probably my fourth or fifth live broadcast. And to be honest, 4 out of 5 have not gone very well. So this is a work in progress. This is beta. Don't forget that. I think the last time I did a live broadcast, we could not hear my guest. So you could hear me, but not my guest. So this week, I have a great guest. Who's none other than Greg Rand from Renters Warehouse. He's a colleague of mine. We've known each other for a really long time. He is one of the most knowledgeable guys on the single-family rental space, and we're going to talk about what some of the big funds can learn from the small funds and things like that. So I'm going to be bringing Greg in here in just a second. Greg,
what's up, Noel?
It seems like it's working.
It does. Hallelujah.
So great to see you, Greg. Why don't you give me a quick synopsis of who you are and what you do and why you do it?
Yeah, sure. Real estate junkie. Ran a company called Own America for 10 years. I had 20 years in the business prior to that. Renters Warehouse was kind enough to buy Own America back in January and install me as the chief strategy officer. And we're trying to bring the best technology and data and personal services together with the biggest property management company in America to help more people own more America.
Excellent. So, I've thought about a lot of different formats for a show like this, and I think getting right to it, sometimes I talk about the housing data, and we all know all that's a lot of fake news. So, and I said it, fake news. So let's talk a little bit about what we're doing, and we're in this unique position with our company is that we work with large institutional funds.
Right.
That is one part of our business. And then we have another part of our business, which is really our bread and butter, which is working with the small to mid-sized funds.
Right.
And what I think is what's been exciting for me on the property management side is seeing the efficiencies that we have to create for institutional funds start to bleed down into the smaller funds, and some of the efficiencies and the things that the small funds are doing, the institutional funds pick up. So that would be my question to you is what could a institutional fund learn from a smaller investor, and what could a smaller investor learn from an institutional investor?
That's a great question. So, and I'm glad you said small investor because, the departments of this company that I'm embedded in is the one that has the small investor and even a fund, individuals who are using real estate as a wealth management vehicle. And everybody kind of knows that the kind of things that the big Wall Street firms have learned as this asset class took shape in Wall Street terms over the last 10 years. A lot can be learned from them, but the little guys and gals, they do a lot of things that the big guys, I think, can learn from also. So I think the thing that has emerged that's been the most important over the last 10 years is this real grasp of what is the true ROI of a single family home in this country, right? For years, like a lot of small investors tell you when you say, well, how's the return on your property? They say, I make $350 a month. And that's not the same thing as I make a 6% yield, right? And so yield is a term that the industry didn't so much coin, but really brought it to the single family rental. But more than that, the institutional world further defined ROI as also including some kind of a quotient for price appreciation, right? The understanding is that you're going to buy a rental house, you're going to generate income from it. It's likely to get more valuable every year, at least if you hold it for a long time. There's only been one time in history where it really did nationally come down. And it's the combination of yield and price appreciation that make up the true ROI, unleveraged ROI. And so we learned that working with the big institutions, and now we're turning it around on this new website launch that we could talk about at the end if you want, where we're trying to define ROI of single family homes as a combination of those two things so folks can see the real power of it because it's beautiful, right? It's an amazing, the fact that you can get 10% on a single family home in a good school district that's in perfect condition with happy tenants, and you're getting a 10% ROI when you combine yield and price appreciation is pretty amazing.
So I think that leads to a question, because a lot of small investors, they just look at that monthly upside, and institutional funds aren't just looking at the monthly upside. They're looking at their true ROI over time, including appreciation. They look at the cash flow in 5 years with rent increases and all of those things. And so explain that a little bit more so that maybe a smaller investor can take something from those larger investors and how they really leverage that, and they're not maybe just relying on that cash flow every month. They're looking at the long term and what it really means.
Yeah, well, it's interesting that all the big funds that we dealt with were all very focused on yield in the beginning. You know, they were like, we don't care about price appreciation, but we know they did. They just didn't feel like they needed to share it with us because we were a channel they used to acquire properties. And they wanted us to basically show me the price, show me the rent. They could figure out the yield from there. We, of course, could figure it out too. But they didn't want to worry us with price appreciation because they use that to figure out what markets they should buy, right? But literally they said, it's all about yield. It's all we care about is yield. Price appreciation is a bonus. And yet they all won on price appreciation. So they bought on yield and they won on the houses, on the recovery, basically. Houses becoming more valuable. But it's all about the dimension of time, right? People who are buying houses to hold them, it's what's it worth now? What's the income now? But how do those two things potentially change over time? And that all ties to demand drivers. You know, I think a lot of small investors make the mistake of chasing deals, right? They think they went to a seminar, they read a book, heard a podcast, and it was all about, watch the TV show, all about finding the biggest dilapidated piece of junk you can and then flip it, right? Where that's a really, really small share of the actual activity in real estate investing. So if you get in and get out right away, that's one thing. If you get in and you want to hold on for 10 or 20 years, then what's the rent now? What do you think it's going to be on an annual basis, right? The data on rental increases has never been more transparent. What do you think the value is going to be next year and the year after? The data on that has never been more transparent. And then just trying to track what kind of, if you buy at a good time, and it's usually a good time if you're going to hold for the long term, but then you focus on those demand drivers. Where are you going to buy? You know, it's really interesting, Noel. The whole deals thing makes me want to throw up, as you know, right? But you ask anybody, walk out in the street, ask anybody what's the number one rule in real estate investing, they would tell you it's location, right? And so that's where the big Wall Street funds began all this, like, where should we buy? And that whole question of where should we buy all was tied to demand drivers: population growth, migration, job growth, quality of life, cost of living in the macro market. And then once you identify a macro market, our specialization had always been within Houston, Texas. What pockets around Houston are going to get extra demand based upon things like, you know, developing housing going in that area, new jobs coming into that subset, new train station, bus lines, highway expansions, making it more accessible, the suburban ring getting wider and wider outside the city area. That's what the big guys showed us. Start with where, and then once you pick the right where, then you'll load up on the what. And the what is the assets, and they don't have to be great deals if you did the first part right.
Yeah, I agree. And I think it's interesting because there was a lot of people who bought that weren't institutional funds who bet on institutional funds, you know, buying them out later. And some of them gambled and didn't work. And it's interesting because I'm seeing a lot who I thought actually probably gambled and wasn't going to work. Now that we have a lot of these mid-sized funds going in and buying, they're market agnostic. It's literally a top 100 market within an hour's drive. They will buy. And so a lot of these guys who have been having it really easy in some of these markets, and there hasn't been these funds coming in. Now you're going to see more, but they're not necessarily the large billion-dollar funds. They're smaller, mid-sized type funds that are buying. And you know, I think what we've learned on the property management side is that there are a lot of efficiencies that are there's a lot of ROI that's been left on the table by a lot of small investors by not having efficiencies in what they're doing, whether that's how quickly they respond to a tenant, how quickly they turn a property, how smart they really are on buying, how they're using data in a sub-market to figure out the right places to buy and really understanding that. So that's something that I think is really interesting because there's been a lot of ROI left on the table the last few years because there was such a great return. Now that's getting compressed and you're seeing people become way more astute in managing the properties and how they buy and where they buy, how they look at it, all those things. And so I think that's where we're seeing a lot of crossover. between.
Yeah, the operational piece is an amazing realization. Reminds me that of, I think it was probably 6-7 years ago at the AmeriCatalyst conference that I know you and I spent time together at. And there was a panel that had a moderator. It had two two CEOs of large single family REITs and two CEOs of multifamily REITs. And they were doing a point counterpoint, easy for me to say, point counterpoint on why multifamily is better or why single family is better, right? And multifamily made fun of single family back in the day, as you recall, right? I remember the multifamily guys saying, well, we can put one super in a unit, offset the cost of his salary.
Expense ratio, right?
He's going vertical, right? So he's driving a golf cart around a garden community. And so one roof, one driveway complex or parking complex. And they were saying, you guys are crazy to be dealing with all these scatter site single family homes. And then they went to the other side and they said, well, how often do your tenants leave you? And they said, well, the average is about every 14 months. Aha, our tenants stay an average of 28 months, right? And so what ended up happening when they were going tit for tat back and forth, the moderator, brilliant question. He says, wait, okay, everybody hush up a second. What's your NOI? What's your NOI? They both said about 60%. All right. And so all these variables, and they were going back and forth on variables that ended up evening out. And what you said about the tertiary markets, you were talking about the efficiency. What single family was dealing with, all the things on their NOI equation, meaning, after all the expenses are paid, they hadn't yet pounded out all of that loose change, right? All that stuff. They hadn't created the efficiencies yet. And so the best operators in the country, public companies, are 65, 67. I've seen 68 out there. So where multifamily probably hasn't changed that much because they've already squeezed all the juice out of that lemon. On the single family side, they squeezed a lot of it out. They've got cloud technology, mobile technology. They've got a lot of efficiencies they've figured out, but they didn't lose their tenant longevity. That's still in place. In fact, they've gotten better. So they learned the maintenance. They learned what it costs. They figured out when it's July and your air conditioner broke on this house and it's 6 years old, just fix the damn thing. That's what the large multi-unit SFR owners figured out, that sending somebody out there has a cost. Putting duct tape around it and juicing it with Freon has a cost. Having the tenant be ticked off because it was blown again on July 4th weekend has cost. And it's going to blow again before the end of the summer, if not next summer. And so they said, even though it's kind of limping along, just tear it out and replace it, right? So those penny-wise, pound-foolish decisions the small guys sometimes out of necessity make, or just not knowing the true cost of tenant happiness, right?
I agree, and that brings to a good point, that how quickly you respond to a tenant request and how you handle that process. So I get a lot of questions in property management that talk about the owner experience. And in my opinion, the owner experience is one thing. They should be able to look and see how their property's doing, see how it's performing, see how the communication went. But the experience, your customer, is the tenant. As an owner, as an investor, as a property management company, as what we do on the property management side. So if you have a tenant that you're Band-Aid fixing things, and then you come up to a lease renewal and you say you're going to raise the rent $50, that tenant many times is either going to say no, or they're going to move out, and there's going to be a huge cost of loss of re-tenanting, the loss of rent, and then you're going to have a bigger issue come down the road where you spent all this money Band-Aiding something where you could have just fixed it outright. And so that's a prime example that we see a lot, and that's where a lot of the institutional funds are really good about that. And what I find is a lot of smaller investors, they look at it and go, well, I made $350 on this month. I can't have anything that costs more than $350.
Right.
But they're not looking at the bigger picture. And so sometimes real estate investing isn't for someone if they need to live off of the cash flow, right? And the short-term cash flow. They buy one property and they need to live off that money. They really need to look at it as a long-term and try to build that portfolio. Get past the 5 years, get 5 properties in 5 years, or things like that.
Yeah, or just take this concept of a 10% of your rent going into a maintenance reserve account seriously. Yep. Right? The only reason why you don't fix something is when it's like, gee, I was going to get my transmission fixed, or it's holiday season. I don't feel like doing it. Put a Band-Aid on it. the maintenance reserve, which we recommend 10% of your rent, go to a side account. That way, when something breaks, you just say, yes, fix it. Because you said something very key. The tenant's the customer. The house is the product, right? Go to a restaurant where they've got dirty forks. You're not going back, right? Rent a house where the guy says, so the paint's cracking. I can't afford to fix it. But if you could, because of the set aside. But to that point about the customer, I would actually flip this one, that the large investors, the large Wall Street clients could have taken a lot of knowledge from the small investors, because a lot of small investors do that white glove thing.
Yep.
Right? Like that. So that it took a while for the big investors, I think, most of them, to really get their brain around the idea.
Oh, yeah, you read the news articles in the beginning.
Yeah, that also helped.
Yeah.
When they had tenants sitting there saying, I'm waiting 6 weeks to get these cockroaches out of my kitchen. But understanding and internalizing the idea that they're a customer, and I'm not sure it was any altruistic thing for the small investor. They were getting it right, many of them, because they met the people. They knew the people. The idea that, hey, the lawn maintenance hasn't been done. I know investors who are like, I'll be right there, lawnmower in the back of the truck, and they went and cut it themselves because they were so bummed out the last time a tenant left because they did a bad job. But they also internalized because of the personalization of it. And I think the little guys could have taught a lesson. Better said, the big guys could have learned a lesson. Sometimes the big guys think you can't teach them anything. You know the type, right? Yeah. I went to Yale, and so I know everything. Well, how long have you been doing real estate investing? Here's a guy like, I can name a bunch of people.
Names.
Yeah, exactly. What I was going to say is the people that really know. These small investors, there's a lot that the big players could learn or could have learned earlier from the small players. Just this concept that we in this industry who own rental property are in competition with home ownership, meaning everybody wants to own a home, probably. At some point, they're going to go and do that, probably. Odds are. If we can hang on to them 2 or 3 years, if they stay 5 years because it's so damn good, like I make a phone call, stuff gets fixed. I make a phone call, the lawn gets cut again. I have people coming in this weekend. I don't call a landscaper. I call the same people that I called when the furnace was on the fritz. If it is, and by the way, I pay nothing. So the landlord's got to write the checks, but I have this concierge service that I call my property manager or my owner, and stuff gets fixed. If they stay an extra year or two, the economic impact on that investment goes through the roof.
Yeah, absolutely. And I think, so that's where, the institutional investors, where they don't have an advantage over the smaller investors on just that local market knowledge and passion about what they do. They can't compete with them on scale. And, on pricing, I mean, look, we see what portfolios, and that's kind of where I want to segue to, is a little bit about how portfolios are trading, how things are doing. That's a lot about what I'm focused on and we're focused on the brokerage side. I get a lot of people that I talk to them about the portfolio, and they say, you know what, I've had a ton of offers. They're all lowball offers, and I'm not interested. And what they're not realizing is that there is now a market to buy portfolios and to sell portfolios where there wasn't before. And we've talked about this ad nauseum. It's what we're putting out there in social media. We're really about this. You can now, there's a fair market value to your portfolio. There's a fair market price that investors are paying, whether it's a single investor buying one property or it's an investor buying an entire portfolio. It's happening, and I haven't seen this kind of enthusiasm behind the space since 2012. And so that's really exciting about what we're doing and what we're trying to build on the brokerage side.
Yeah, well, listen, think about this. How many clients have we met that went out and bought 10 or 60 or 100 or more rental homes, and they knew there'd be an exit someday. Then that day came, and they didn't realize there was nowhere to go with that, right? And so they go and they call 100 real estate agents. And here's the way that conversation goes. Hi, my name is Greg. I've got 37 properties I want to sell. The agent falls off her chair or his chair, gets back up. This is my lucky day. I got 37 listings. Then the bad news comes. They're all tenanted. They're rentals. And the agent goes, oh, I thought I had a whale on the hook. Well,
they do.
They do. But the advice they give that owner is, here's what you got to do. As those leases come up for expiration, you just got to get those tenants out, and you give me each of those houses, and I'll list them for you. And so the translation, the agent is saying that, what the owner is hearing, what you got to do is you got to start taking those cash flowing assets, turn them into negative cash flow. Like you're making money, start losing money. you're going to have to fix them up, paint them, carpet cleaning at minimum, maybe the whole punch list. And then you have the privilege of paying me to list the house one at a time. So I've got 50 of them, and you want me to do this 50 times in a row. And the reason I wanted to sell it is that, like, my wife and I are done. I want to go to the beach and retire. And now it turns out that what took me 25 years to accumulate is going to take me 4 more years to liquidate. But that's the advice the industry gives.
And the tax burden, because it's practically impossible to 1031 exchange multiple sales. I mean, you're going to get killed on the fees there anyway.
Torture. It's like drip. It's not. So what you said is key, is that the idea that a single family rental portfolio is a beautiful thing unto itself. It's a unique thing. It's very relatable to an apartment complex. It's different, but as we said earlier, it's a similar NOI, maybe even a better NOI. And so having a transparent market where buyers and sellers can come to terms, the values are essentially, what are the houses worth if you add up all the market values of them, subtract out whatever they need repair-wise to make them perfect, and that ends up being friction costs. And usually it's about 92% of market value is the portfolios that we've seen over the years. Yep. You can get 92, 93, you're basically dead even on market value, because the cost of breaking this thing up, destabilizing it, losing money, and then spending money ends up costing you 8 or 9% of the value anyway. So having a ready place to serve it up to is gold.
Yeah, and I think our biggest challenge right now is just getting the word out to letting these mid-sized portfolio holders, anybody that owns up to 250 homes or so, all the way down to 1, to understand that there is a way for them to sell their homes, and that there is a market for it. We have buyers that are interested. We have sellers. It's just, everything is coming together. It's more of getting the word out. So last few minutes here, let's talk about our marketplace. You're on the front lines of a lot of new things we have coming out soon. I just want to throw this into this because it's really interesting to me, and it's a passion that that we've had since the back in the day when we were first kind of working together, and what we're creating and the purpose of it. You explain it better than anybody else.
Well, thank you. I appreciate that. So yeah, we're calling it Renters Warehouse 2.0. And I want you to picture that single family investment has been this fragmented, disconnected process, right? There are 16 million, 17 million existing rental homes in America, and every one of those owners did it the hard way, because you got to find the property. The realtors don't know anything about yield or investment. The data wasn't there. Zillow is a great website, but there's no investment data up there. And then you go through the entire process. You have to figure it out for yourself. There's all this bad education out there about get rich quick. So the portals aren't built for you, right? They're built for home buyers. The realtors aren't built for you as an investor. They're built for home buyers. And then property management just downright is fragmented and painful. And so the perfect scenario that we envisioned, and now that we've built and we're releasing it shortly, is upon this foundation of a property management company, because Renters Warehouse is the biggest in the country, managing 22,000 houses. So upon that operational foundation, that granite, we've built a real estate company. And so in every one of our 40 branches, there are licensed real estate agents. They've been trained and equipped to be investment specialists. And on top of them is this new portal, and that launches in about a week. And so renterswarehouse.com is going to have 1 million MLS listed properties and several thousand off-market rental properties in a general search, the same inventory you could see in any other real estate site, except you're looking at it through the lens of investment quality. So we've got rental estimates, expense estimates, therefore yield estimates. We have price appreciation models in there. So you can see, and they're all very transparent. You'll know what our numbers are. We don't make them opaque. So you can see, well, okay, I'm looking at Orlando, Florida, and this neighborhood over here is a 9 3/4 yield, or these houses are. So therefore that neighborhood is, but this neighborhood over here is a 9 7/8 or a 10 1/4. Well, why? Right? And so the research at being able to look at a national inventory of properties through the lens of ROI, true ROI, yield and appreciation, causes you to start to realize a couple of things. One, it's all very consistent. It all ends up somewhere between an 8 and an 11 combined, but how it got there, right? Cleveland's is a high yield, low appreciation. DC and Austin are low yield, high appreciation.
Right.
Isn't it amazing that no matter where you go, it winds up landing in a similar place, but it gets there in different proportions. So that experience is going to be much better. Then you hop off the website, you have a conversation with a real estate agent who actually knows what you just did, understands what you're talking about, asks you questions about, well, how old are you? How long until you retire? What's the purpose of this portfolio? Because the first question is, what's the purpose? Retirement. Okay, how many years till then? How much discretionary income do you have? What are the goals of your portfolio? These houses over here seem to fit or they don't seem to fit. Here's what I think. So you bulletproof your plan. You go in with confidence, you make your acquisitions, and then you drop the keys off and you move on with your life, right? So that's the dream, a vertically integrated portal brokerage property management company to at last make what is really difficult a whole lot easier. And we think that if there's 1 million investor purchases a year going on right now, that we're going to get a big chunk of that because they're all doing it the hard way and we've just invented an easy way.
Yeah, I agree. And it's like I said, I haven't seen this much enthusiasm around this space, not just because we're in it, but in general since 2012 or that period of 2012 to 14. So super excited. All right, Greg, thanks for coming on the show. We'll do another one soon. This seems like it's gone very well so far. So really appreciate you coming on, and look for Renters Warehouse, Greg Rand, and everyone else in our team out there on social media. If you're watching this video and you want to know how to get in touch with me, you want to learn more about the single family rental space, go to renterswarehouse.com, go to our YouTube channel, contact me directly, and I can share with you any information I know. We love to share our knowledge. This isn't, we're not educationally charging for people to learn what we know. And my focus with our company is finding portfolios for some of the investors that we're buying and helping these investors realize their return, realize all the hard work that they put in by selling their stabilized portfolios. That's a big focus